Hello and welcome. You are watching In Your Interest here on News 9 Live. I am Krishnakumar, and on the show tonight we are talking about something very much in your interest, your investments in your mutual funds for the month of October 2024. A remarkable 82% of equity mutual funds have outperformed the benchmark stock market indices. 226 equity mutual fund schemes out of the 275 in total have beaten market expectations. Just 49 of equity mutual funds fell short. This strong performance highlights the growing confidence in equity mutual funds even as market conditions continue to remain volatile. Notably, during the month of October, contra funds achieved a 100% outperformance rate. To understand what is the best way going forward, is active investing in active funds the best way, or can we still stick to index funds? To understand that, we have a couple of very special guests now joining us. We have Mohit Gang, co-founder and CEO of Moneyfront. Mohit, thank you so much for taking time out to be with us here on this edition of In Your Interest. We also have Mr. Feroze Azeez, Deputy CEO, Anand Rathi Wealth, joining us. Feroze, lovely to have you on the show again. Thank you so much. I'm going to begin with you. Talk to us, active investing versus passive investing at a time when markets are volatile. Equity mutual funds have overwhelmingly outperformed the benchmark indices. Same time, contra funds as well. What is the best way forward?
Good evening. Like you rightly said, a large portion of equity funds have outperformed their respective benchmarks, and that's a very, very staggering 82% of them having outperformed. First, to understand the outperformance theory or underperformance theory, we need to understand and have a fair expectation from a mutual fund platform, because mutual funds are designed to manage risk. See, return is an external variable, risk is an internal variable. Return you can only pray for, risk is what you manage. That's why textbooks always say risk management, and when it comes to return, they say expected return. Then nobody says return management and expected risk. So that's point. What I'm trying to get to is that when markets fall, when risk happens, is when a risk manager starts shining bright. October was one of the bad months from an external variable standpoint, and Nifty fell from its peak on 27th of September from 26,200 odd to almost about 23,850 last week. So October brought some degree of reality check for the markets, and any fund manager who's trying to manage risks looks relatively prettier than the benchmark, because benchmarks buy everything depending on past performance. All benchmarks are created and weightages are given. Larger weightage is given to stocks which have performed very well. So that's a growth kind of mentality, and fund managers are value more or less, and risk managers. So that's the great news.
Okay, that is the great news. Mohit, great news in general when mutual funds perform well. But then many investors watching this, retail investors watching this, did sort of settle on that, let's just put it in index funds and wait it out for a while, and then we'll get where we need to get to. That kind of a mode had happened with considering all the volatility. But clearly, that has not taken the sheen away from investing in equity mutual funds.
Oh, absolutely, Krishna. So look, honestly, I think my thought on this one is that when you narrow down the time zone in which you are analyzing, you will find cases which are fairly strong for active funds, and sometimes you might just find it the other way also. Cases which are very strong for passive funds, right? And we have had phases in equity markets for last 2 years. If you were to just analyze data and you were to you were to actually figure out that. On the mid and small cap sides, most of the active funds have actually underperformed the benchmark, have underperformed the passive funds. But on the large cap sides, in fact, almost all the active funds have beaten the benchmark hands down, barring one or two maybe, right? But if you were to go 2 years behind the timeline and then track the data for those 2 years preceding the last two, then you will figure out the reverse story was true, which is that on the large cap side, the index was actually beating all the active funds, and on the mid and small, the active funds were beating the index. So the story flips around every couple of years, every quarter, every month. It all depends on the lens at which you're looking at it. But from a very large perspective, Krishna, if you zoom out and if you were to look at the overall scenario from a 10-year, 15-year, 20-year perspective, I'll just give you a very small data point. On a 10-year perspective, almost 50% of the active funds have underperformed the index. But if you zoom it out to 20-year perspective, then there are only two active funds out of the total observations which are available to us, which have actually beaten the index. So the more you zoom out, the more you will find the index actually averaging out everything and outperforming. The lesser the zoom period, the shorter the period of focus, you will find abnormalities, you will find active beating index time in and time out again.
All right. Feroze, even within mutual funds, active mutual funds, you're seeing contra funds outperform 100%. That's a staggering number, isn't it?
Yes, it's a staggering number, sure, Krishna. And like Mohit said, that 1 month periods, there could be 1 month periods where all of them outperform. There could be another 1 month period where all of them underperform as well. But in our experience, see, if you're a retail client, then an index fund is still okay because for 20 years you will not buy and sell. But when it looks we are in the business of private wealth management, we have about 11,000 clients. I've made in my model portfolio as an Anand Rathi Wealth almost about 39 changes from 1st of June 2013. And if you look at the alpha generated over index funds, that's a staggering, very large number. So I don't want to put it here. Basically, if you're able to be nimble footed and agile, because mutual funds are cyclical, like HDFC FlexiCap, I exited in my model portfolio in May 15, re-entered that on January 21. Prashant Jain's 5-6 years worst period we were out, and fortunately that's a right call. We also go wrong several times.
Okay.
But net, over the last 5 years, my portfolio would have beaten on a 10 crore base 7 crore alpha. So I would not go with the Warren Buffett strategy, which is go only to index funds because he's sitting in the US at the age of 94. And India is a far more relatively simpler market where you can create alphas if you apply some mind and you are agile enough and married to equity for 20 years, but not married to a scheme for 20 years.
Married to equity for 20 years. Mohit, this debate, has been going on for a while. Once upon a time, it was like, putting money in index funds was like putting in the equivalent of putting in FD, in a bank. But then eventually it came out on top because of all the changes and the shifts that took place with the stock markets across the world. And now the question is being asked again, why settle for a passive index fund?
Look, Krishna, I kind of agree to Feroze on that count that if someone can really actively manage ins and outs in a portfolio, then yes, perhaps active allocation to certain extent deserves merit in a portfolio. And in a country like India, we all agree on that one common thing that yes, there is enough and more opportunity. And if someone were to really manage it well, you will definitely outperform and beat the index. My problem only comes, and which Feroze again pointed out, that if you were to really be a kind of a slightly more hands-off investor, sit and focus on your core work and not just focus on the market and not just focus on the performance of the funds or the stock markets and everything, and you really want to zoom out, right? And then you have to believe in the power of averages. Perhaps the data suggests on a 15-year 20-year kind of scale that passive has beaten or index will beat most of the active performing funds. Having said which, I would again believe that there are many paths to God. One would have to choose which one serves you best. And my sense is a combination of active versus passive is perhaps the right way for every investor to go and then judge for himself or herself what strategy works well for him, right? And how much of involvement does it require or does not require, and then figure out what is working best for the portfolio. And next 5 years, perhaps take a call into which direction the markets are moving and what direction the active philosophy is actually working well or not working well.
Feroze, that is the question then when it's clear that you've got to be nimble-footed, both of you in concurrence on that matter. How does the retail investor approach this? Because the whole idea is that they're not the money managers, they're not the people who have to do the tough job of tracking the markets. If you have to be nimble-footed, what should be a good split, and who should split it how much? Because age group-wise is a difference, isn't it? Somebody who's investing at 20, somebody who's investing at 40. How do they make that split between active and passive funds?
I personally think, yes, you're absolutely right. A retail investor would want to be, like Mohit rightly said, if you're not going to be moving around, you have to believe in mean reversions, which is a very, very strong principle. So I would say active and passive both might have a role. But I think what I personally think that there's hardly any understanding of industry participants of how indices are created. Okay, if I ask somebody, why do we have 10,000 crore companies not a part of NSE 500? There are 34 companies greater than 10,000 crore market cap, not in NSE 500, in spite of the NSE 500 having 5,000 crore companies. Because there are some rules, there are 6 rules in which NSE 500 is created, and those two of those rules are very, very funny and tricky. So there are quite a few companies which are very large in size, but not a part of NSE 500. They are part of Morgan Stanley's Emerging Market India Index, but the Indians don't follow those stocks in the index. So there is a lot of homework which one needs to do, even buying an index fund. Because if there are 500 stocks, there could be 10 stocks which I don't believe have the best corporate governance. I don't want to invest in them and make money off them or lose money off them, because I fundamentally don't think investing in a company just because of its past performance, it comes into the index, is fundamentally right. And being valuation agnostic. When you invest in index, you are saying that valuation does not have relevance, because higher the valuation, higher the past performance, more the weight. Because all indices in India are created in a certain fashion, which is growth fashion, apart from those index funds which have smart beta as their strategy. So retail should ideally look at indices, but 84% of the money which is there in index funds is in NSE, Sensex and Nifty. That's the reality of it. So 84% is in Sensex and Nifty, and Sensex, 70% of Sensex is in the top 10 stocks. Of Nifty is in the top 10 stocks. So there is a lot of homework which needs to be done when you buy an index fund and have your foundation principles right, and if that marries with your thought process.
Okay. Okay, you have to have your investing principles right, Mohit, but it's getting increasingly complex for the retail investors. And you've got to be nimble-footed, you've got to be investing in active funds, you've got to be investing in passive funds. Talk to us. We are not discussing something called as ETFs or exchange-traded funds. How do they stack up as an alternative?
Look, so basically, most of the ETFs are also formats of passive investing only, Krishna, right? So when we're talking of two philosophies, which is active versus passive, we are encompassing everything. Whether you choose the mutual fund route, which is the non-exchange folio-based route, or you choose the ETF route, which is the exchange-based route of buying funds, you're predominantly relying on a passive strategy, basically. Though you might have ETFs which are actively managed also, right? So, but again, I'm saying these are all different formats of selecting your pick, right? But the broader question still remains: what works well for an investor, which is, should he go the passive route or should he not go the passive route? And within that, whether he should choose an ETF route or whether he should do a fund route. To honestly, I think there aren't too many equations which kind of solve that issue for him. But only one thing, which is, there are many ETFs where liquidity becomes an issue at times, and the bid ask spread could be very high, and their investors have to be extremely careful. I'll just give you a very quick example. There's been a sudden rush of money into China funds, but if you see few of the China ETFs, their NAVs are much lesser, but they are quoting on the exchange at a very high premium, because those are ETFs and new unit creation cannot be done in them because of certain restrictions by RBI. The existing units are quoting at a premium. So that's not the right strategy for the investors to go, but most of the investors might not actually know that that is happening, right? But if they go through a fund route, you have a fund of fund which is available through a mutual fund route. At least you are pretty sure that you're buying at the NAV which is available, and liquidity is never a concern because the fund house is backing it up. So there are intrinsic advantages of an ETF. There are intrinsic advantages of a mutual fund. My sense is that these are certain complex tasks, and these are best left to the judgment of the individual advisor or the distributor who's catering to the client. Sometimes it could be very difficult for a retail client to assess what is the best possible mechanism or the route to buy funds, but each one has its own pros and cons, Krishna, at times.
Okay, each one has its pros and cons. Feroze, I wanted your take on ETFs, as the option. Are retail investors better off investing in ETFs or everything else?
I think I would completely concur with Mohit that ETF is another ball game. I think buying an index fund is so much better,
Okay.
because little do people know that there is an STT difference. If I buy an index fund, a ETF of Nifty, I spend 36 rupees buying and selling in the form of STT. Index funds have an STT which is significantly lower than an ETF. People love to see the low management fee of an ETF, but they ignore an STT, which is a reasonable hefty penalty vis-a-vis an index fund. So I personally think an index fund where you buy and sell with the AMC is a better choice for a retail participant. And I don't think the cost, the little incremental cost, is worth. But I think the most important thing when you're buying a passive is to try and see how close to the index has it been. Most 90% of index funds underperform the index which they're supposed to mirror. That is not spoken enough, because you're in an active fund, at least there is a chance that you will outperform. In an index fund, you're sure to underperform by a small margin because of inefficiencies and costs. So that's one thing which you should see. If you find an index fund which has a positive tracking error, great, go for it.
Okay. So ETFs doesn't really stack up in the way they're meant to, but talk to us going forward. You're seeing all that's happening in as far as the stock markets are concerned, money flowing out to China, foreign investors pulling out, DII is making up for it. You've seen what's happened with the US elections. Keeping that in mind, when somebody wants to enter the markets in a mutual fund route right now, what is the best way of going about it, Mohit? Is it better to put in a lump sum into chosen equity mutual funds, or take that lump sum and split between 50-50 split between equity mutual funds and passive funds?
Look, Krishna, two parts to this entire debate, and this honestly is a perennial debate which goes on whether it's the right time or whether it's not the right time. Honestly, yesterday was the best time, and today is the second best time. But for people who have the conviction, who have the gumption to take the volatility and have the time frame of 10, 20 years, then yes, by all means go lump sum. But otherwise, for broad base normal investor and normal investor psyche, I would always suggest that when markets are so choppy and volatile, you go with a 6-month STP. I think that's the best possible route you can adopt to just kind of even out a little bit of volatility on that one. Whether you go active, whether you go passive, again, as I said, there are many paths to God. My sense is you have to take the best of both the worlds. I wouldn't actually honestly go all out on one of the strategies. I would always make a mix of both of the things. I would have some portion in active, some in passive, and I would also have some in smart beta, which is factor passive. Right. So I'll just combine all these three strategies and then try and create a portfolio to get the best of all the worlds and all the investing styles per se. My sense is uh, uh, you can diversify across asset classes, across market caps, but diversifying across investing styles is equally paramount, and doing that through factor-based passives is one of the new trends which we have seen, and I firmly believe that one should also try and adopt that route while investing.
Okay. Feroze, wanted to quickly get a check with you. Talk to us in terms of where do you see the markets headed? Nifty at 24K, is that a possibility? Can it settle over there? And generally, because for when we talk about mutual funds, you're also talking to retail investors, telling them how the markets are going to be for the next 6 months, considering all the factors from Trump to what's happening back home.
Yes, Krishna, in my belief, markets have two kinds of corrections. One which I call correction, the other is just a small little second nature of the market. Markets every 10 months have fallen 10% for the last 24 years. That's the average drawdown period which is there in the market. So I think today we are about 8% lower than the peak. So this is a good opportunity for one to enter, in my belief, because I don't see any catastrophic fall and a reason for a catastrophic fall, which is what an investor needs to be worried about. A trader needs to be worried about the next 200, 300 points of Nifty. But an investor needs to be worried about only one thing: is there a catastrophe in the making? If the answer is 99% there's no catastrophe in the making, you can invest, especially when you're not at 52-week highs. If you're 8% lower than 52-week highs, incidentally, you should grab it. That's point one. Point two, according to us, the earnings of Nifty this year have to be 1165. We have finished 2 quarters. 1 quarter is done. There was 262 rupees of earnings last quarter on Nifty. This quarter, so far, 39 companies of Nifty have declared results. 192 rupees is in the bag. So we're looking at 1165 very closely. So that's the earning on a base of 1048 last year. That will be a growth of almost about 10 odd percent on Nifty. So far this quarter, 8% is the growth after Tata Steel declared its result last weekend. So what am I trying to get to is that there is not so much of a froth in the market. If we're looking at 24,000 divided by 1165, which is this year's earning PE ratio, I
Right.
don't think you're getting more than 21, 22. And we'll, in the next 5 months, finish this
Right.
financial year and start discounting next year. So I'm reasonably happy with the valuation. So lump sum investment is what I would recommend after this correction.
All right, we will leave it at that. We're completely out of time on this discussion. Feroze Azeez, Deputy CEO of Anand Rathi Wealth, thank you so much for taking time out to be with us. And we also have Mohit Gang, who's with us. Thank you so much, Mohit, co-founder and CEO of Moneyfront, for being with us here on this edition of In Your Interest.